You've been on the road marketing your new book, How to Listen When Markets Speak, and you've been all through North America, all through Europe. And I'm curious, what sort of feedback are you getting when you speak to individual investors? What are they most concerned about?
Well, we're really fortunate because the thesis of the book comes down to the questions I get the most are like, okay, are we really in this multipolar world? And that's one of the main core thesis tracks of the book. So think about from 1968 to 81, it was a multipolar world, more global tensions, and totally different portfolio construction. The power of labor unions were more sustainable, more powerful. So you have a lot more sustainable inflation forces coming out of the Vietnam War. You had a lot of fiscal spending from the Great Society with Johnson. And so the similarities, the questions that I get, the similarities between, say, 1968 to 81 to now are just off the charts. And, unfortunately, portfolio construction today is really looking backwards. And if you look at the average portfolio in America today, the families, everybody's 401k is really designed for a 2010 to 2020 portfolio. And the point that we make in the book is you really need to start thinking about a 1968 to 81 portfolio.
And can you elaborate on that? Why do you think there's similarities between 1968 to 81 and now?
Well, the biggest reason is you can see of late government, the government largesse and money printing. The Great Society, we're coming out of that incredible period of what we call fiscal overdose in the 60s with the Vietnam War. Wars always bring out Neil Ferguson. I sat down with Neil Ferguson with the book, and he's probably the most famous financial historian, but he makes the point that, wars are just really typically bring on sustained inflation forces for multiple years. They just don't go away. Obviously, we had COVID, but now we have the labor unions. We have oil prices that are higher because of that multipolar world where you got tensions in the Middle East. Right now, the debate is, not if, but when does Israel strike Iranian oil assets or nuclear power assets or nuclear weapon assets? So it's really a much different world today. And but that's, if you think about the portfolio construction, by the time you got to 1980, 81, say the portfolio, so the S&P 500 was essentially 50%. The S&P 500 construction was 50% energy, materials, and oil and gas. 50%, 50. And when we started to write the book about a year and a half ago, in recent years, we've got down to 12% for those groups.
Well, I guess the one thing that comes to my mind is that the 1970s versus now, there's no comparison. I mean, in the 1970s, you didn't have any of these massive tech companies like Apple, Microsoft, Amazon. You didn't have AI. There's so many sectors that didn't even exist back then. So therefore, there wasn't as many asset classes you could invest in. So of course, there's going to be a much more higher weighting toward energy.
Right, for sure. But the other aspect in the book that we talk about is this whole artificial intelligence. Nobody's really doing the math on all the data centers and energy consumption and the amount of copper you're going to need to really build a power grid that's going to sustain all of these extra. I mean, essentially, potentially a Germany and a France of extra power consumption into the United States, potentially, in terms of all of these data centers. So we talk about nuclear power in the book. We talk about companies like NuScale, companies SMR, small modular reactors, companies like Microsoft and Google. They're going to need their own power sources. And so the trade over the next 10 years is going to be toward infrastructure that's going to have to support all this additional energy demand. And we have a power grid in the United States. It's essentially 50 years old in some spots and 30 years old in others. That's nowhere near strong enough or young enough to really support all of this. What we call is like a lot of bullshit BS when it comes to artificial intelligence. Nobody's in order to get to where the street's telling us we're going to go, we just don't have the energy infrastructure to support it.
Thanks for watching, everybody. You've been watching Jimmy interview Larry McDonald about his book, How to Listen When the Market Speaks. And we thought this would be a great opportunity to bring in Brett Rentmeester from our partner RIA Windrock Wealth. Brett, thanks for joining me. And we're going to talk a little bit about what Larry spoke about. Now, Jimmy had asked him about what investors that he speaks to are concerned with. I'm wondering, after watching the clip, if you're finding the same thing about what investors are concerned with today.
I mean, generally, yes, Andrew. From the perspective of there's a great unrest right now. Yes, stocks, markets are up tremendously, but under the hood of that is, a great concern about policy. And, I think when we talk to investors, there's probably 4 or 5 things they bring up. The main issue has to do with spending, debt, and money printing. People aren't stupid, and they generally know that there's a price to pay for printing money out of thin air and overspending and not having reasonable budgets. Now, that doesn't happen immediately, but that price over time is inflation, higher interest rates, and even a devaluation of the currency. So the currency is also on people's minds, the US dollar, both from that perspective, but also as we kind of face a growing BRICS coalition looking to get away from a dollar-centric world. And then 2 other factors. We're in one of the most overvalued stock markets on paper. So that's in people's, consciousness. And then finally, and maybe most importantly, I'd say a period of political and institutional instability. The segment before was talking about a book, The Fourth Turning, which I brought off my shelf, one of my favorites. But the insight is that at a fourth turning or a crisis period in history, people lose faith in the institutions that they accepted in the past. So, I think we're looking towards those kind of issues ahead.
Now, he also talks about the period the period we're in now is kind of echoing the period from 1968 to 1981. You and I did an interview about a paper you wrote about 1974. So tell us about what you're finding about this period compared to back then.
Yeah, we did. It was called Echoes of 1974 and can be found on our website. But I would concur with a lot of his thoughts. Now, of course, no 2 periods are the same. And the world was very different then versus now. But we had essentially 5 lessons from the 1970s that I think should still resonate with people today. And if you think about that period, 1968 to 1981, it started as a period of low inflation, and we ended with almost 14% or higher, actually 16.5% short-term rates by 1980. So let me just list the 5 lessons. One was that inflation and interest rates, although they're volatile, they were upward trending and they went in a wave. They weren't straight line. People thought inflation was maybe okay, and then it came back. So, I think we're probably heading down that path once again. The second was that anytime you have extreme market valuations, you're going to have a period of pain at some point. Back then, it was the Nifty 50 stocks that in 1974 lost over half of their value. Today, it's AI and other things people are excited about on the technology front. The third lesson was anytime you have political instability rising, you have a loss of faith in government. Back then, it was Nixon and Watergate. Today, I don't even need to go into all the political instability we're talking about around the country. The fourth, and again, a mirror of today, was called war, energy in the Middle East. So we're kind of back to that same dilemma and instability in the Middle East. And then finally, on a longer term basis, was the insight that there's a changing of guard in currencies about every 100 years or so across the world. Now, that period back in 1971 was important because that's when Nixon officially took us off convertibility to gold. Since then, we've been running in a different kind of world with really no regard for currencies tied to something of real value. So, the question is, from this point forward, what lies ahead for the dollar?
Brett, in his book, Larry also, and in his discussion with James, he also spoke about the positioning of our portfolios and how right now they're sort of geared towards 2010 to 2020, but they're not evolving, I guess, the way they should. Is this something you agree with? Or do we need to revamp the way we look at our portfolios?
I think we do. I think we need to rethink the wisdom of kind of the conventional 60-40 portfolio or stock and bond mix. Both have pretty tremendous headwinds going forward. For stocks, the headwind is overvalued prices. So even if a company delivers on the promise, are they just overpriced enough to not really make money? For bonds, it's really about interest rates. So if interest rates rise, that's a major headwind to bonds, and you end up losing value over time. So I think, again, taking some of the lessons from prior periods, mainly the 1970s, if you have a scenario of overvaluation where interest rates are rising, that tends to hurt most stocks and bonds together. Now, we saw that back in 2022, which was one of the worst markets on record for U.S. investors, when stocks and bonds both fell together. People are used to them behaving differently, but that wasn't the case. So, our guidance is, hey, we live in the world we live in, so you've got to have one foot in the current system. So you probably are going to have some stocks and bonds. But on the stock side, you should be hedged. You should be more in value names, hard assets, energy infrastructure, like master limited partnerships are an area we've had a lot of success with. On the bond side, you should probably be thinking about interest rate risk. So maybe short-term treasuries are a good place to hold out. But outside of that, the foot outside of the system would be thinking about what could go wrong in the world. And with that mindset, I think you want to consider precious metals, both gold and silver. I think there are a lot of other hard assets that tend to do well in trying times. And there's some unique niches like build-to-rent real estate that you and I spoke about that, as it gets more unaffordable for people to buy their first home, people are choosing to rent, but they want to do it in a more home-like, system. And then finally, cryptocurrency, still a wild card, but something that investors should consider as the world keeps printing money out of thin air.
And Winrock is innovative in that way. You look at alternative investments and not just equities or bonds and stuff like that, right?
That's right. I mean, it's a big part of what we do. And honestly, I think it's why clients end up finding us, because they want someone bringing them ideas and not giving them what worked yesterday, but more of a list of things that are likely to succeed, under the conditions we laid out here.
Yeah. So if you're looking for help being financially stable and keeping it that way, given the uncertain economic times, you can head over to wealthion.com/free and you'll find Winrock. You can head over to winrockwealth.com and find Brett and his partners, and they'll certainly be able to help you out and point you in the right direction. That's for sure. I mean, that's why we partnered with you, and we trust you, and you've done a great job for us. But we'll do this from time to time. We'll have Brett and his partner Chris and Brandy on to try and give some perspective onto what some of our other guests are talking about. So Brett, thanks so much for joining me. I really appreciate it.
Thank you.